morning. You're watching a home broadcast of Businessworld Live. I'm Danie Laurel. It's 10:30 a.m. this Tuesday morning in Manila. We are about an hour into the last trading day of the second quarter of 2020, guys. Let's go straight to our top story. Many BPO firms are expecting losses or flat growth this year. That's as the pandemic continues to batter the economy. An informal poll by the Information Technology and Business Process Association of the Philippines, or IBPAP, has shown. Of the more than 70 members polled by the group, 18% said they expect revenues to contract, while 36% see their business to remain in the flat territory this year. Nearly half, or 46%, are expecting growth, but only within a range of 3 to 7%. IBPAP CEO Rayontal said it's these smaller companies that are bearing the brunt of the crisis, noting that these firms are working on fewer contracts. Of the industry's 1,300 companies, 42% are micro, small, and medium-sized enterprises, according to Ontal. More than 1 million Filipinos are employed by the industry. Meanwhile, he says the bigger firms can better cope with the challenges brought by the pandemic because they can realign their workforce to other projects. Now, despite this, BPO companies are restricted from returning to full capacity because of internet woes in the work-from-home setup. He also notes that outsourcing firms face data security issues, saying some clients are not keen on approving a shift to a remote or a work-from-home scheme. Opening my terminal with you guys here. Check out your screens. Let's kick off on the global front. Some good news on that front. You've got the U.S. pending home sales surging 44.3%. They had reported that yesterday. That had exceeded all forecasts. That is actually a record gain. And you can see here on your screens how the Dow Jones had rallied up by 2 3/10%, S&P as well, and NASDAQ. And good news is that Asia Pacific is following suit. So that positivity spilling over. You've got the Topix and the Nikkei 225 rallying from yesterday's losses. Recall that yesterday was a painful day for the entire region here. But not just them, you've got the Hang Seng as well, and also Chinese markets now reopened after having been closed last week. And this is, of course, opening higher, setting to round out the best quarter, hopefully, we've seen since 2009. The MSCI Asia Pacific Index is also set for a 16% gain this quarter. That's the biggest gain we've seen in 11 years. Although, of course, this follows right after the worst quarter we had seen since 2008. So a very low base to be watching out for here. Another thing to be looking out for, Hong Kong assets. They will be closely watched after the Trump administration suspended some trade benefits for the city. Some good news as well for China. June manufacturing came out. That's a PMI that was 50.9 versus the analyst estimates of 50.5. So better than expected, and also above 50 print, signaling expansion. Let's take a quick at our own local index, the PSEI also joining the regional rally here. We are back up at 6,100 levels. You can see on my screens here, that is up by 0.6%. I'll pull out the 3-day chart so you can see here how it sort of cratered on Monday after having rallied on the Friday after that surprise cut by the Bangko Sentral, but it slid for 4 out of 5 sessions in the past 5 sessions. And this, of course, amid rising coronavirus cases here in the country. And also some comments from our central bank governor yesterday. He indicated that second quarter GDP may contract by as much as 6.7%. Still, the good news is that the gauge is up close to 15% in the second quarter. So it's set for its best performance in 7 years, along with the rest of Asia. But net foreign selling continuing to swell. We saw 7 of the straight days of outflows yesterday. We lost around 910 million pesos. Now, one to be watching out for here is the property space. Recall that in our banner story here, it was all about the POGOs possibly posting still flat growth, but still not necessarily as good as they had. We had also reported yesterday how the POGOs are exiting. I mentioned BPOs earlier on, rather. POGOs are also seen to be exiting by several property analysts here. You can actually see the property gauge actually up by 0.9% in the first trading hour. And this, of course, follows them having been also in the red yesterday, along with the rest of the sectors. Bloomberry, for instance, was down by as much as 9%. So a lot of the casino stocks and property stocks were sold off. Megaworld had led the declines as well yesterday. You can see that it is now rallying by 6 and 7 tenths of a percent. Astro Del Castillo, who is, of course, at first grade finance, mentioned that the continued withdrawal by the gaming operators will hurt the prospects of casino companies and also developers, because this is, of course, a key market for residences and offices. Now, speaking of Megaworld, let's zoom in on that. You can see on your screens here their first quarter earnings, and that had been hit by mall closures. So the first quarter of 2020 saw their revenues up by 1.3% to 15.1 billion pesos, but actually their net income was down by 7.9%. You can see that on your screens here. So again, net income down by 7.9%. And what have they been saying here? They did mention that this was due to, of course, the pandemic eating up their retail sales, especially in their malls. So they had to close their malls. But the good news for Mega World is the fact that they actually managed to keep the real estate sales up, and the office portfolio as well. They mentioned that their office portfolio was still very attractive to locators because they're mostly PESA accredited. So there was a bit of a buffer against the expected weakness. Other parts of Megaworld that were hit were, of course, the hotel operations. This is according to their chief strategy officer, Kevin Tan. But they did mention, they've been overcoming the 1997 and 2008 crisis. They say they have a strong financial position. You can see also on your screens here, as I mentioned, Mega World actually up by 6 and 7 tenths of a percent. But also the fact that you can see that the residential accounts for 64% of the pie. The rentals, however, so that's residential sales. Rentals, or the recurring revenues, are up by 28% of the pie. We're actually up by 8% in the first quarter, but hotel revenues, which are around 4% of the pie, were down by 4%. Now, speaking of Mega World, let's move over to their parent, which had also just announced their first quarter net income. Also, not a pretty picture for them, suffering a double-digit earnings drop. That is Alliance Global. Their first quarter net income was down 32%. To the tune of 3 billion pesos. That's on the back of revenues down by 7.3% to 38 billion pesos. So they are saying, however, that early digital transformation initiatives will be helping the company to adapt quicker to this fast changing environment. They're now focusing on township developments as the way of the future. Now, moving on from the property space into the renewables front, there's so much news on that front. We've been reporting on FGen. They have, of course, received finally they did the tender offer from Valorous. Valorous Asia accepted tendered shares representing 11.9% of ownership of FGen, and that's, of course, a unit of KKR. And this, as I mentioned, is actually higher than what they were targeting earlier on, of just 6 to 9% of FGen's common share. So again, a bigger chunk of equity. Now, what is the reaction here? This from Federico Lopez, who's their chairman and CEO, saying the company felt, quote, quite honored of KKR's confidence in the company. Now, recall that KKR is not very new to the Philippines and previously invested in the hospital unit of MPIC and also Voyager, which owns Paymaya. So their investments now stand at $1 billion here in the country. Take a look at my terminal here. FGen surging by 4 and 6 tenths of a percent to 23 pesos and 95 centavos. And finally, still on the renewable energy front, I just want to take a quick peek at AC Energy, because they are not done bidding on Infigen. So again, this is an asset, a company that is, of course, in Australia that operates a lot of renewable energy. They had entered into a bid, but later on, that bid was trumped when Iberdrola, which is, of course, a giant Spanish company, Spanish energy company, came with a revised offer. And they are now trying to beat that offer. So previously, it already told the Infigen had already told their shareholders to accept Iberdrola's bid, but Ayala Corporation and its subsidiary, which is UAC Energy Holdings, which actually holds a 13.4% stake in Infigen, has now increased its bid to 0.86 Australian dollars per security. So very, very interesting battle here. The battle's not yet done. AC Energy up by 1.4% to 2 pesos and 20 centavos. Meanwhile, let me scroll down to other headlines we are watching this Tuesday morning, kicking off with a region-wide wastewater project in Metro Manila will be expiring today, with its main backer, the World Bank, noting that the project has yet to meet its targets. The $275 million project started in 2012 and was supposed to expire June of 2017, but was extended to this year. The multilateral lender gave a moderately unsatisfactory evaluation of the overall implementation progress. Now, according to the World Bank, the project was able to reach 72% of the 2.4 million household target. The completion of the Kupang Sewerage Treatment Plant by the third or fourth quarter of the year was supposed to add another 13% to the progress. However, private concessionaires failed to meet their construction targets as of May due to, of course, the nationwide lockdowns. The Asian Development Bank, on the other hand, has approved a new $26 million loan for the country. This is meant to upgrade LGU's tools in real property tax collections. The ADB said adopting to digital tools may help boost revenues and make for a transparent and efficient collection and reporting. Estimates place for gone property tax collection as high as 30 billion pesos from 2004 to 2016. The technical adjustments form part of the government's comprehensive tax reform program. Now, still on renewable energy, a renewable energy fund will raise up to $2.5 billion in Southeast Asian renewable energy products. Now, this is to support the region's recovery from the pandemic with a focus on the Philippines, Vietnam, and Indonesia. Southeast Asia Clean Energy Facility, or CSEF, said the capital type funding initiative will, quote, fill the gap in financing early stage clean energy projects in the region. The investment will support the development of solar and wind facilities and energy storage, as well as technologies accelerating low carbon transition. The initiative is managed by Singapore fund management firm Climb Capital and is backed by private foundations like Bloomberg Philanthropies and London's Children's Investment Fund Foundation. An initial $10 million has already been injected into CSEF, while an additional $40 million is due shortly. Overseas Filipino Bank, or OF Bank, launched its new fully digital system on Monday with hopes of reaching more Filipinos around the world through online banking. The Land Bank subsidiary said that it is the Philippine government's first branchless digital bank. OF Bank said OFWs and their beneficiaries can apply to open an account and submit all requirements online through the mobile app. OF Bank President and CEO Leila Martin noted that the app uses advanced encryption and security technology that protects sensitive information. So to open a new account, applicants will have to take a picture of themselves, and OF Bank will compare it with the valid ID submitted for verification. OF Bank account holders can transfer funds to other OF Bank and Land Bank accounts without any charges, but a 25 peso service fee will apply for interbank transfers via InstaPay and 15 pesos for PesoNet. Doing well by doing good. That's what BPI is hoping to achieve during these challenging times with their newly launched Care Bonds. I was interested to learn more about the specifics of this product, and we have with us live on the stream Eric Luchuangco, Senior Vice President and Head of Business Banking of BPI. Good morning, sir, and welcome to the broadcast.
Morning, Danie, and thanks for inviting me here today.
Eric, this sounds really exciting. I mean, when you take it at face value, but it's obviously a very new product. There are going to be a lot of questions surrounding this. Give us a better description of this. What exactly are Care Bonds? How much are you planning to raise? How big of a pie is this in your whole bond portfolio? And who can invest in this, and how can they do so?
Yeah, well, actually, we're really very quite excited about it, right? I mean, and it's not so much for the size or for the impact to the overall bank, but because of what we think the value added we think it brings to the economy and to our clients that it will affect. So let me just talk a little about the bond itself. Basically, what we're looking at doing here is a minimum of 3 billion bond issue with a tenor of 1.75 years, so a year and 9 months. Interest rate on this is going to be 3.05%. So this was actually priced before the BSP rate decrease. So it's actually a very good value.
Mm.
And we're currently in the offer period already, which started on June 22 and is going to last until July 17, with the listing of the bond currently scheduled for August 7. Now, what's exciting, I think, about this bond issue is really the use of proceeds, right? Because what this bond will do will go to financing and refinancing our micro and small and medium enterprise loan portfolio. And as you mentioned earlier in the program, these are the businesses that are more vulnerable to a pandemic, to the current pandemic, and to difficult economic situations. So we want to make sure that we're able to do as much as we can in order to really help out this sector. And it's quite exciting for us also to be issuing the first SEC registered COVID response bond.
Super exciting, Eric. Now, just compared to other bonds, what would the risk profile be like? So when I'm, buying into a corporate bond, you want to know what you're going to be using it for, expanding the company. You're supposed to be using it for these sort of purposes and not necessarily refinancing loans of companies that are already in trouble. So isn't this, a question that a lot of people are going to be asking? Like, I'm going to be putting my money and you're going to be using my money to help people with their financial woes.
Yeah, that's right. But I think that's really one of the beauties of investing in a bond like this, knowing that the proceeds of this bond will really go to helping out companies or smaller enterprises that can really use the help. And yet, the risk to you as an investor is that of BPI, because even if the loans on our book, the loans that are used to finance this, even if they experience trouble, really it's the bank standing behind the bond, and basically you have the full faith and recourse to the larger bank, which includes its entire portfolio, including its most safest assets.
How do you select where the proceeds will go? I mean, it can't be every single MSME that has tapped your loans. Are you doing a sort of assessment process on which ones are more sustainable, which business? Just to be clear, these are not necessarily sustainable businesses. These are not necessarily green environmental projects, right? These are any retail or small MSME. So tell us how you make an assessment and whether you're going to be monitoring these investments in the future.
Well, we continue to monitor our investments on an ongoing basis, and therefore, because it's also important for us that who we lend to remains to be in decent shape, and this is really meant to help businesses kind of transcend the current difficulties. It's not meant to bail out a company that really does not have a viable business model, but it's really meant to help companies that are experiencing some temporary difficulties because of the current environment. And so we continue to monitor the kind of companies that we lend to, and to use that as kind of to further along our basically help build the economy further. Now, in a sense, these bonds, you can say that, or sorry, these companies, they're not all necessarily green companies, but contributing or helping them along I think you can view as sustainable for the overall Philippine economy, because the importance of the SME sector is still very high to the economy, right? They depending on how you measure it, as much as 63% of employment is with SMEs. And so therefore, in order to keep a high employment rate in the company, we have to be able to help support these companies in being able to continue on with their business.
Sir, care bond or no care bond, what have you been doing so far as a bank to help these companies during this let's say three months of a lockdown, 100 something days already?
Yes, well, basically, I mean, I'm sure you're aware that the Bayanihan Act has provided for all companies, not just SME companies, all companies and individuals. So basically, all borrowers to be able to postpone their debt payments due during the ECQ period until after the quarantine has been completed, understanding that basically these companies have not really been able to generate revenue during this time, and so we've been in full compliance with that. But we've also recognized that as companies come out of this ECQ period, a lot of them have not really fully restarted their businesses. Customers are not fully coming back to them already. And so what we're doing is we're working with our customers individually in order to reschedule payments even beyond what is required by the Bayanihan Act. In addition to that, what we're actually also in the process of doing right now, we haven't announced it yet, actually. So this is basically the first time I'll really be talking about it in public, is that for our smallest borrowers, and I'm talking about the smallest 2,000 of them, we're actually working on an interest rate reduction in terms of the loans that they're paying, right? And so this is to offer even further assistance, and this is above and beyond what is required by the law. But we're offering it because what we see is that companies like this that are kind of in a bind right now are going to need some additional assistance, and so we're looking at offering kind of a rebate on some of the interest that they're paying. Not a complete one, but basically reducing the costs of the business in order to be able to make their business more sustainable.
Great. Can BPI afford that? Maybe, just taking a step back here, and assessing the bank in general. I mean, there are a lot of concerns on contagion, especially when a bank is very close to retail in this period. And you've already made a lot of provisions on non-performing loans. How will these care bonds actually improve the capital adequacy, if so? And how confident are you that you have the buffers that it takes to actually be reducing the interest rate you're collecting?
Well, first, with regard to capital adequacy, I think BPI is in a very comfortable position. We've got over 15% in terms of capital
Tier
adequacy. So yes, so we're good with that. We believe that that's enough for us to be able to operate profitably even during this period. And when I talk about being able to offer this to our clients, I'm really talking about kind of our smallest 2,000 customers on the SME book, right? And therefore, in reality, it doesn't translate to a huge percentage of our total loan book. And therefore, even if we do take this reduced income from these clients, we don't believe that it will materially impact the overall profitability of the bank. Of course, basically, this is to some extent reducing our profitability because this is money that is actually owed to us, but on the terms of the original terms of the loan. But we're saying, okay, we'll allow you not to pay that. But it's not so big as to impact the overall performance of the bank.
Okay. I'm just curious on the 1.9 year tenor. Is that because you hope for them to be back on their feet in 1.9 years?
No, I mean, it's actually 1.75 years. So that's a year and 9 months.
1 year and 9 months, yes.
But no, this is, This is in part because that's where not that we believe they'll be back on their feet, but there's nothing to say that when this bond expires, we cannot do another one.
Okay.
In a year and 9 months from now, we could potentially follow it up. But this is where we think that investors are probably works for them as well, and we really want to make it a blend of what works for us in order to be able to help out our borrowing customers, and also works for the investors.
Okay, 3 billion is not a small amount, and actually to buy into this care bond, it's I think a 1 million peso minimum, right? So it can still be between retail and institutional. And now with interest rates going lower, is it still a good time to be investing in bonds? We wanted to invest in it last year, would have been great, but is this still a good time? And also with so many issuance, as you've got corporates issuing left and right, you've also got
Mm-hmm.
the central bank now issuing securities, treasuries also. Tell us why we should invest in care bonds instead.
Well, I mean, a couple of things, right? I mean, when you talk about interest rates going down, I mean, obviously, the BSP just recently lowered the overnight rate, right? And in a sense, one of the unintended benefits of this was the bond was actually priced before rates were lowered, right? So it was based on the a higher interest rate environment, and then subsequently interest rates went down. So in a sense, you're getting in a sense, kind of the best of both worlds, because you're buying it after the interest rates were already lowered. Um, now, I think it's again a very good. The bond is very attractive because you know that we're going to be applying these proceeds towards helping out our SMEs, and yet it's really backed by the full faith of the entire BPI institution, not just one small part of our portfolio that is probably a little riskier than the bulk of our portfolio.
Okay, so banking on people actually having an ingrained, desire to help out while also keeping their money safe. Thank you so much for those insights. That was Eric Luchuangco, Senior Vice President and Head of Business Banking of BPI. Thank you, sir.
Okay, thank you very much. Thanks for having me.
Okay, guys, I want to do a quick check on our markets here before we end the broadcast. Let's see if our index is still joining that regional rally. We are up. You can see my terminal here, up by 0.5%. That, of course, is not as good as, let's say, the other Asian indices or benchmarks we've been seeing. Let's take a quick peek at our sectors here, whether there are some that are lifting the sentiments here. You can see actually it's still a mixed picture, so not really broad-based gains. Financials up by 0.9%. They were the most heavily sold off yesterday after having rallied on Friday last week after that surprise BSP cut. Properties as well in the green and holding firms, but you've still got industrials and mining and oil sitting out this rally. Let's take a quick peek at which ones are leading and which stocks we should be watching this Tuesday morning. You can see Megaworld, as I mentioned, we had just broken those earnings for the first quarter. It seems that despite that, this of course was reported also yesterday, so a lot had possibly priced that in. But Megaworld is leading that charge up by 6.2%. First Gen, which has just finished that tender offer of Valoros, also in the leaderboard, that's up by 5%. But you've also got Alliance Global, which I had also just broken this morning. So investors just getting a hold of those first quarter earnings, down by 32%, actually rallying by 2%, but you've still got some sitting out the rally. Aboitiz Power down by 2.3%, and Security Bank down by 1.1%. And just a couple of stocks that I wanted to report on very quickly before I let you guys go. One is San Miguel. they have mentioned, so a lot have been questioning what are going to happen to all of these construction projects because of the pandemic. They have said all expansion projects will be continuing amid the pandemic, with the major businesses well positioned to recover. They say food expansion projects, the new breweries in Cagayan de Oro and Santa Rosa and Laguna, Masinloc Power Plant, and several projects on infrastructure. So Skyway 3, Skyway Extension, MRT 7 rather, and the T-Plex will still be pushing through amid the pandemic. They will also be pushing through with the airport. Of course, they're still having a lot of impact negatively on the Petron side as well. But they mentioned that they are also looking at online channels for food products in different types of platforms. So they're going to be selling food products in Lazada, for example, Zalora, and Shopee. So very interesting pivot there to for e-commerce as well from the San Miguel food group. So very exciting times. However, that does seem to be sitting out the rest of the rally in the bourse as well as the regional rally. San Miguel shares down 0.2% to 99 pesos and 30 centavos. And that's the first look into the business day this Tuesday, June 30, the last trading day of the second quarter. Catch us again tomorrow morning, 10:30 a.m. I'm Danie Laurel, and we are One News.